Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Andy Baehr, Head of Research and Index Product Development at CoinDesk, as well as Jill Kwok, co-founder and CEO of EasyA, and Dom Kwok, COO of EasyA. We're here to discuss recent developments with digital asset market structure and how it could potentially take shape. Great to see all of you, as always. Welcome back to the show. Andy, that's really the question. What's next now that there's been some changes in terms of how the industry is interpreting bills that are on the table?
We've marked 1 year since Inauguration Day, right? Which I'm kind of thinking of as the freshman. You can tell I have high school age kids at home, right? So we're thinking of this as a freshman college year for crypto when it's begun to matriculate in like the largest and most important institution of capitalism in the United States. And it had a mixed year, right? It had stumbles like it's done over the last couple of days based on tariff concerns, really strong second and third quarter rallies, and then it kind of failed that auto deleveraging midterm exam last October and had kind of a heartbreak ending. So it was a mixed freshman year for crypto, and we have to try to avoid a sophomore slump. Out of the gate, again, tariff thing, nobody likes tariffs, so tariffs have weighed on the market. But as you point out, this Clarity Act stalling or the Clarity Act bill passage delays are really what is holding people back from thinking, how do we get to that next level?
Yeah, I wonder if there is a challenge to the ethos of what this is supposed to be around, decentralization, but incorporating more traditional finance compliance applications to the space. I wonder if that's what it's struggling with.
I think definitely. I think one of the big concerns that I see right now, and I think other industry participants are seeing right now as well, is what if we have all this infrastructure that we've previously built in DeFi that now gets bundled up with all the different regulations that typical banks have to deal with. And I think that a lot of banks are seeing obviously DeFi becoming this competitor to them, and they want them to be drawn in, but they're very, very different products. They're very different technologies. I don't know if we can even refer to banks as technologies, but DeFi is definitely technology. I see it as being infrastructure. And so we need to make sure that it's treated very, very differently as opposed to being lumped all into the same thing, which I think, to your point, would lead us into, a very, very different world.
Yeah, Dom, I think Phil makes a great point there that there were so many operations and structure that has been built. And now the question is now what? I mean, we saw the catalyst that the Genius Act had provided, and it almost seems as if it fits and starts in the space sometimes.
Yeah, exactly. I think the Genius Act was a great thing for the whole space. Now I think the Clarity Act is introducing a couple of different hurdles, like you were just talking about, for different crypto companies looking to provide those solutions to their different customers. And I think ultimately crypto is always centered and founded around the fact that everyone should actually control their funds themselves. There should be a layer of secrecy around individuals in the space, in a good way, of course. Privacy, rather, I think is a better word. And they shouldn't have to pass all these different checks and give up all this different personal information in order to have a crypto account, so to speak, kind of like you would have to have with a bank account.
Yeah,
so I think, yeah.
You took the words out of my mouth when you think about it from the privacy perspective, and we're seeing this in the healthcare space as well. And finance, we're using regulations that are grounded in a different century, that were made for perhaps a paper economy, but with a digital economy and digital capital markets, regardless of what happens with the Clarity Act, these it needs to be updated as it is. We're not going to stay stagnant.
100%, exactly. And times are changing. People want to operate in a different way. They don't want to have to go through a 100-year-old bank in order to operate today. And I think crypto is really the future. And obviously, as we go through that transitionary period, there's going to be a bit of backlash towards that change. But I think crypto will prevail, of course, long term.
Yeah, it almost feels like the bank lobby came out of nowhere.
It does, but the crypto's always been about individuals wanting to take control. And that has traditionally meant like, okay, well, I want to take control with Bitcoin and make this my sort of non-central bank guaranteed sort of store of value and exchange currency. And it's expanded. It's becoming an investment or trading vehicle. And now with stable coins, okay, well, what do I do with my idle money, with my money that I want to remain pegged to the dollar? So, step by step, that has woken up the securities and commodities industries and the derivatives industries, and now it's waking up the bank industry. So maybe this kind of realization and self-control over one's financial destiny is just, is the movement continuing. In the end, though, banks have to realize that deposits serve a different function and probably may not be as much under threat as the stablecoin kind of self-actualization movement may suggest. So it feels like there's a lot of room for everybody to play.
Yeah, it certainly does. So where it stands now, any impact on the payment space? Is it business as usual?
I think from the perspective of where we're seeing this going, I think that the big thing is going to be yield for consumers, right? I think that that's where the risks lie for the everyday American and people worldwide, actually, because it's going to have, what happens here is going to ripple across the world. So I think it's a case of banks saying, look, traditionally we've been able to offer these sort of interest-bearing accounts. This is where consumers have been able to deposit their money. And now there's actually an alternative that is a better solution. I think that that's where we're going to see a lot of this, this battle play out. You're right. It seems like these banks have just come out of nowhere and suddenly been like, look, we've woken up. We see this problem. They threw out this number of, we see $6 trillion in deposits leaving our system. And that's going to present huge, huge structural risks to the way that commercial lending works. I think that a lot of that is potentially blown out of proportion. And I think that really it's just fundamentally there's a better product that's now out there and users can use, and banks are scared.
So a very elementary question so I can understand this, and I would imagine the audience has this question as well. I bank at a very large institution and I make 0.01% on my savings. So I may go into a different type of bank where I'm getting 3.25%, right? Which is definitely a lot more than 0.01%. How is that different than not having the option to get yield on your stablecoin accounts?
Exactly, and I don't think it's very, very different. I think that when we have these different options available to us, I think that from the bank's perspective, it's no different to there being another competitor to them, but they see this as being a much bigger competitor. I think that they see this as being, look, there's something very, very new. We want to make sure that this doesn't turn out to be another competitor. And ultimately, we've already seen a lot of consolidation as well amongst banks. So banks who weren't offering the same amount of interest, we see a lot of local banks and regional banks as well. They've consolidated, and a lot of them have been closing down as well. So I think this is part of a broader shift where we have this competition that's coming up, and banks are ultimately just looking at, okay, well, how do we make sure that we don't have as many competitors out in the world?
I thought banks were building their digital asset divisions and investing in this type of technology.
Yeah, they are. They definitely are. I think obviously, the way that banks work, they take a lot of time to actually do things. They take a lot of time to figure out ways to, maybe deliver interest rates that are competitive to the different options that currently exist in the DeFi space. So obviously that's also going to eat into their profit margins if they have to give out more money to the end user and the end consumer that is actually banking with them. So it all takes a lot of time, all eats into what they're doing. And I think, beyond the sort of immediate ways they've gotten into the space, which is, trading, number one. A lot of top banks have trading desks that allow them to actually make money for themselves, trading crypto, et cetera. It's going to be a lot more of a longer journey, so to speak, for the banks to actually figure out ways to build products that actually compete competitively with stablecoins and the higher interest rates that they offer. Because like you're saying, banks are currently very low on the interest rate side, whereas crypto has many suitable alternatives on the stablecoin side that offer, 5, 10, 15, depending on your risk tolerance, much higher percentage rates when you're looking at putting your money in those different stablecoins.
Well, what is the risk there? 10 to 15% sounds really too good to be true.
No, exactly. Sometimes when it sounds too good to be true, oftentimes people wonder, okay, what are the risks, And I think ultimately there are risks that your money ultimately isn't there anymore. And, it really depends how those yields are generated. And I think that's a big concern over where the yields actually come from for a lot of consumers. It's like, how are those generated? Yeah.
And to that point of the risk, I think the banking lobby has done a very, very good job at making it seem like banks are risk-free. But ultimately, the reason we have these banking regulations is because they engage in fractional reserves, right? They have fractional reserves. They don't have reserves. For every single dollar you put in, there's not a dollar necessarily backing it. They're lending it out, right? And so fractional reserve banking is the reason that we have all these rules. And I think that obviously DeFi is still nascent. We're still working things out. There's still risks that maybe need to be better disclosed. We need better audits as well of different pieces of the puzzle. But I think that a large part of what banks are maybe papering over is the fact that their system isn't necessarily the most secure either, and is really being, the reason these regulations are there is because there is so much risk inherent in what they're doing.
Well, that's why it's called the Great Financial Crisis.
Yeah.
Right. Not to be flippant, Andy, it almost feels like that it's very productized as well.
Deposits may be the only thing that can't convert into a blockchain world, right? Because look at the announcement from the New York Stock Exchange a couple of days ago. They have a new program to tokenize securities and trading platforms. Derivatives exchanges are converting, not only offering things like futures on single names or futures on crypto indices, but actually native things, DTCC, asset managers doing tokenization. So a lot of the rest of the industry is rushing towards it. Even the structured product desks at JP Morgan and other places are saying, we can do this, right? We can do this either virtually through ETFs or directly. Deposits, you kind of can't, right? Because you have deposits coming in, you're a part of the Federal Reserve System, you have to place excess deposits with the Fed, fractional reserve banking system. You can't just throw in some stable coins in the mix there. So it may be the product that is most resistant to evolution, and maybe that's why you are facing the most resistance to change right there, because otherwise the only possible explanation for resistance is discovery, that people are going to realize that they're only receiving 0.01% interest, and they now they have a wider variety of options to change. So the difficulty is that with clarity being held up by this kind of singular issue, is that all the other good things that we need, right, more permanent structure around how the financial regulators, the CFTC and the SEC, regulate trading and investment and asset management and other parts of digital assets, that could get held up. And that's really the foundation that the industry needs to really convert crypto into an investing asset class. Whereas right now it's kind of still a trading and a discovery, necessary kind of asset class. It needs to evolve, and it needs that regulatory foundation like the 33 Act and the 40 Act before it, to sort of make the next leap. Yeah,
which is so interesting, Phil, because it was a consumer-driven concept initially. And of course, I don't think it's a binary or, a zero-sum function where it's, either centralized or it's either decentralized. And it felt as if that we were getting on that path towards constructive integration. And it was surprising, especially how the language had changed so quickly going into at midnight the day before it was announced.
I agree. I think it took a lot of people by surprise. I mean, when we were looking afterwards as well, and we're like, well, where did all of this come from? And it's almost like there were these lobbyists who came out last minute. I don't know exactly. Like I wasn't there when it all happened, but just looking at it from the outside, being like, wow, where did this all change? And to your point as well, I do hope that we can potentially not maybe look past, but I feel like we are so close, and we are literally so close. We have the Genius Act, we've got all this momentum, and especially coming into midterms, we want to make sure we don't miss this window.
Yeah, I mean, the longer this plays out, the harder it's going to be to get bipartisan support to get this thing passed.
True. Yeah, exactly.
Yeah. Well, it's interesting, and I use the analogy to healthcare before, again, another consumer-driven space where there are privacy regulations as an example. Well, guess what? Everyone's wearing a smartwatch or any other apparatus. When there's frameworks around your PHI, your personal health identification, well, guess what? I'm consciously making that decision to put that out there, right? And
exactly.
and I mean, you can make the argument.
Key point, though, you're making the decision, right?
Right, and that isn't the ethos behind this conversation consumer-driven.
Behind consumer-driven is a blessing and a curse, right? Because you end up discovering the most interesting things, but for the rest of people, some people need stuff sold to them, right? And financial services really wouldn't be able to have the same scale and uniformity if there weren't armies of salespeople making sure that people understand stuff, right? Not everybody can discover Bitcoin in 2010, right? Some people just have to be sold it in 2026. And when I think about your guys' business, EasyA, and bringing in founders and coming up with new applications and trying to identify big new use cases and need cases of the future, financial services distribution strikes me as the thing that both has the biggest scale potential and is almost the most necessary to help the digital asset space, both stablecoin and money market fund, and also risky asset oriented, to move to the next level. We need salespeople.
Yeah, and I think that's part of to your point about what we're building as well with EasyA. It's like we've built up this amazing distribution network. We've got all these users who are really excited about using these products, and what we need is just clarity, right? We need clarity over what's going to happen when you use them, how can you use them, because we are building out our own protocols, we are building out our own products that are going to allow people to tap into this much more easily. We talk about distribution. We need a very clean front end that anybody can just use as simple, well, I was going to say as simply as a banking app, but actually the banking apps aren't too great maybe, but as simple as a neobank, where you could just go in, or like a Venmo, right, and go in and you send money. You send money as simply as pushing a few buttons, or you're like, okay, you know what, there's a better yield rate available on this application. Let me just tap, one tap to go. As opposed to going and having to switch. You mentioned you could switch your bank and maybe get a little bit of a better interest rate. That process is really, really hard, right? We need that sort of upgrade to this financial system, and that's what we want to help to build.
Totally agree. And you're selling to the buyers, and I think we need to start selling to the sellers. Right. We need to create incentives to have people look at those options and be advisors and distributors and wholesalers and product creators and actually start to help in the push to get more people to adopt. I think that we're discovering, we're reaching saturation for the people who are naturally interested and want to discover these things on their own and optimize rate, and we have to go sell to everybody else.
That's a good point about distribution. I actually never thought about it in those terms.
Right.
Again, it feels very binary, like TradFi, DeFi, but that's
correct.
But that's a really good point.
No one would conceive of a fixed index annuity on their own and build one and code one up in their basement and say, here, somebody designed this for me. It gets sold to them over their dinner table, and that's why there's trillions and trillions of those things, and many of them help people, right, with their longevity risk and things like that. I think we need to get to that place because not everybody is going to, is going to go down that self-discovery road.
But you also don't want to lose track of the fact EasyA is an example. There was a problem, you provided a solution, right? And Phil, you had made the point before where once the U.S. gets traction, the rest of the world, it's available at scale. Well, the rest of the world has actually been leveraging this technology and built it, providing those solutions before it got here. I think some credit needs to be delivered there.
No, exactly. No, definitely. I think, with EasyA, our goal was really to build those applications, bring those developers in, inspire them to actually use the different technologies that are out there, whether it is, Ripple's XRP Ledger, whether it is Solana, all of these different amazing alternatives, and actually help them to build these products for the consumers, because ultimately our users are consumers, and they are a lot of times DeFi first, crypto native people, and they understand what they want, what is actually ultimately beneficial for the broader consumer like them, those people at the frontier of these amazing different technologies. So for us, that's been something that we've been very much focused on, and we'll continue to really spend a lot of time on.
All right, so distribution, that's what we're focusing on moving forward. Appreciate all of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.